Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, December 15th, 2023. It is 12:35 p.m. Eastern Time. So I'm starting the video, and I'm going to, in this one, I want to cover the semiconductors. I mentioned wanting to get to those in yesterday's video, but I was only able to get to the SOXX, the SOX Semiconductor ETF. There's three big ETFs out there. So I'm going to cover those ETFs in this video as well as the individual holdings. I was gonna wait until the closer to the beginning of the year because I want to put out kind of 2024 long-term, swing trend trade ideas with some price targets and a lot of what I call static charts, screenshots. That's easy for a lot of you guys to reference. I know in these videos, that's where 90% or plus of the 99% of the analysis I provide is in these videos, and I know that's sometimes hard to archive or reference. Keep in mind, I do make a point to put the symbol tags on every homepage post. Down below the post, you'll see it says tagged. Those are what I call symbol tags, and they're hyperlinked. You can click on it, and so that shows you what was covered in that video. And then the best way to do it when you're on YouTube, you can skip ahead. You can drag the little thing on the bottom, especially if it's viewed on YouTube. And you can kind of see the charts I'm covering. I'll do that. I don't have a video queued up or I'd show you what I'm talking about, but I'm saying just click and hold and then drag on the slider at the bottom, the time slider, and it'll populate, the part of the video up above. So you can kind of see as I transition through different stocks or sectors. And that's one way to reference things. I do that all the time myself. But I'm going to start out here. I know this is not a semiconductor, but I try to cover, been trying to get to the questions and comments put to me, and I missed one yesterday. It was in one of the comments from the day before yesterday, on Wednesday, I believe it was. I meant to reply to it in yesterday's video, and I missed it. Somebody asked me for my thoughts on BMY. They said it pays a nice dividend. So here it is. This is the weekly chart. I'm going to add a few more lines here. You can kind of see this is just big picture stuff. This is wash, rinse, repeat. Let me do this. Let me take away those lines and show you probably the most important ones here. Oh, that one was meant to be there. That one wasn't. So I got to put that one back. Let's just put it back the way I had it. And this is, again, a weekly chart, big picture. This is kind of what I do. The big part of my analysis has these divergences, and you just have to be patient when you're trading a weekly time frame. As I often say, you've heard me say it a lot, especially recently as these divergences continue to build and are being ignored by the market, that they don't always play out. Not 100%, but darn near it, well over 60, 70, 80, I'd say. And again, depends on market condition, depends on the actual security or index. In other words, I've learned over the years there's certain things that kind of certain technical analysis, certain technicals work on some things better than others. In other words, divergences or even sometimes support and resistance level breaks, Fibonacci's. You have to look at every individual security different. But again, for the most part, most typical stocks, especially those that are components of the big indexes, S&P 500, the NASDAQ 100, they tend to work well to that. And you can see here, this is going back years. We're going back into 2013, and the stock was in a strong bull run, started to diverge. And again, as I like to say, it's not as if these divergences didn't play out. That was the first big correction. This was BMY back then, Bristol Myers Squibb. That's 26% drop off that first divergent high. And then, as I often say, divergences can continue to build. So that was DH1 there, right there to that point. And then the divergences grew larger after that 26% correction, we'll call it. It's certainly a correction because it was an uptrend. And then you put in an even bigger divergent high. And as I often say, there are no guarantees, but typically, generally, the bigger the divergence, the bigger the drop. And that was followed by a 40% drop. Okay. Brought us full circle, came back here. We were still in a downtrend. Remember, that was, I'm sorry, to be correct, that was a 40% really on that initial three-wave down. But from that high right there to where it bottomed was actually a 45% drop. Okay, and you can see, you don't have to squint to look at this. This isn't, sleight of hand. This is very clear and obvious stuff. It's just, it was building divergence from that low. It was a major low. It just rallied. The rallies kept getting sold into. It made lower lows. Not much, another 5%. But again, you would have felt a tremendous amount of pain holding along there if held it to this point where you got profitable and then you were going down, 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 seeing all your profits went away, lost money, went negative. Most people would have stopped out 10 times over after that, or maybe taken profits on. And by the way, I missed one. Very important. You had told you, again, based on this, on the weekly chart, go long right there. That was a divergent low. That was DL1, divergent low 1. This was DL2. We had a second divergent low right there, and we had a nice rally. And again, weekly chart, don't underestimate. These are decent rallies. That was 21%. But put another low, and then that was it. So again, let's not spend a lot of time, but there it is. Divergent high, correction, divergent low, rally. And not just correction and rallies. These are like bull trends, bear trends, double well into the double digits. That was a 66% gain right there. That was a divergent high, and it was followed by a sharp, powerful unidirectional drop of about 20, almost 24%. You actually had a little bit. Yep, you had some divergence there, particularly on the RSI, maybe not really on the PPO, but definitely on the RSI. Rally, divergent high. And this brings us to where we're at, guys. So I'm doing that because there's a lot of what I'm going to show you in the semiconductors. You're going to see the same thing here, and it's these same premises. And like I said, more often than not, they play out. You just have to, it can take a while when you're analyzing on the weekly chart. Those are trends, and you can see down here, there's the year breaks here, 2014, 2015. So this is a year, 2 years. These trends we're looking at were multi-year trends, the bear and bull trends, okay? Now, where are we at today? We do not have any divergence. I maintained, right or wrong, we're in a bear market that's only just begun back in the beginning of 2022, late 2021. That's going to play out over years, not months like the previous bear markets. All the big ones that just about anybody and most people working on Wall Street today have lived through. You can encompass in the past, 30, 40 years. The big ones that are most recent were 2000 when the dot-com bubble burst, to 2002, and then 2007, October, late 07 to early March of 09. And those were the two real bear markets. So, call COVID whatever you want, call the other drops. And they were measured in months. They were less than 2 years. So you can measure 18 months, 15, whatever it was, somewhere in there. And again, so we'll see. Now, what I can tell you factually is that was a divergent high. We do not have anything even remotely close to positive divergence, but we do have a very, very deep oversold reading. Again, I talked about this in yesterday's video. That is more atypical. I'm sorry, it is more typical of a bear market to see deeply oversold like this. You pinned down to almost a 20 level recently, or maybe you hit it. Just like in a bull trend, you get extreme overbought readings, and or you stay overbought for an extended period of time. So I did want to point that out. Now, again, this is typically, you don't want to be shorting generally. I'm generally speaking, all other technicals aside, you want to be a buyer down on oversold readings, even in a bear market, but more so, especially in a bull market, because in bull markets, usually one and done. But then you can see here, you do well by buying. I'm just circling each and every, without fail, each and every oversold reading. This isn't rocket science, guys. And again, it's probabilities or no guarantees. But look at that. Do you want to be a buyer or a seller, BMY, at oversold readings? This one, take that line. Yep, that was right there as well. And that's that. So my takeaway, I can't make a case for a continuation of the longer-term secular bull market in the stock. I don't have the divergences. In fact, if anything else, I'm guessing, and I didn't do this yet, I'll go out to a monthly and I'll tell you this just jives with everything else I'm seeing out there. We're seeing... It's super rare to get negative divergences on the monthly time frame, because monthly time frame, that's a super long time frame. It speaks to the big picture I keep talking about, not where we're going to be today, this week, how far this bear market rally is going to go, but where we're going to be, 1, 2, 3, 4 years from now, how the market's going to play out. And this is just, and from my experience, these divergences on the long-term time frames work every bit as well as they do on trading short-term time frames, daily, inter-period charts, intraday charts. I mean, like a 60-minute or 5-minute for active trading. They just forecast or predict or indicate a much bigger move. There's that's a decade-long span where this divergence has been building, and it started there. And really, that was the first monthly divergent high, and it sent the stock down for a period of years right there. And, got the stock, a lot of it was, a lot of the value was taken out of the stock, put in just recently, and even larger. And it's just simply an extension of that previous divergence that was already building here. So that's kind of longer term. Probably spending more time on this one stock than I wanted to, but it speaks to everything, a lot of the other analysis I'm going to show you in the semis and the stock market and everything else. And there was another long-term trend line. There was a divergent high there on the monthly that foreshadowed that bear market, which lasted, you can see in the pop-up box, 8.2 years and took 80% out of the value of the stock. And that was a relatively small divergent high. There was another one on the monthly right there. And then that's it. That's as far back as we go. And there was your trend line break. So based on the scope and magnitude of this divergence, again, it speaks to what I'm seeing long term. So to answer the question on that, oversold on the weekly, deeply oversold. I like that. Positive divergence on the daily chart. I wish this question was put to me, a few weeks back, because the stock has already rallied off that divergent low, a total of about almost 9%, but it's pulled back a little bit. You want to know what I think? Just kind of eyeballing the chart. And again, right or wrong, I don't have a super strong opinion, but it looks to me like this doesn't look like a washout move, selling climax. I could see this divergence getting a little bit bigger. In other words, another leg down, a marginal new low is what I would favor. Me personally, I wouldn't be buying this stock right here, but there it is. You have a divergent low. You can put a stop right under the recent low. You can buy it here with a tight stop if you think this is going to carry up here. Targets would be right there, 53.15. That's its previous reaction low from when the market bottomed back then in November, October. And then you have a beautiful downtrend line. Now this is its bear market downtrend line. This stock is a sick stock. This is BMY, great company, Bristol Myers Squibb, been around forever. But when it's doing this, and a lot of other stocks, and even a lot of pharmaceuticals are at or near multi-year or 52-week highs, and this thing's 40% and it's coming off the bottom. Something's going on with this company. I don't know. You guys can do your own due diligence and on the fundamentals. I'm just showing you levels. So if you want to buy it, be careful of high yielding stocks. They call that a dividend trap sometimes. There's usually a reason why one company is going to be yielding a whole lot more than the average, and that's because there's problems. Whether you read about it or know about it, the market is much more efficient than the headlines you're going to read in the paper. And if there's pricing in a stock and its dividends 2-3 times its competitors, that means the company is at risk of cutting that dividend. There's problems there. Otherwise, the market would recognize that. There are rare exceptions, and that's what the experts try to do, is come in and say, oh, this is an overreaction. But just kind of be careful with stocks. The higher the dividend, the bigger the chance there's a problem with that company, and that dividend may be cut, whether or not the headlines are talking about that now or not. So there's your analysis. There's your levels. Take it, leave it. If it, feel free to bump me again. And again, I showed you the oversold reading on the which isn't a buy signal, but I just showed you these were every single one without fail, high double-digit returns. We're talking 40, 30, 40, 50% or more. So hey, maybe. All right, moving on. Again, 13 minutes on the first stock, but a lot of takeaways that you can use on that chart that I just showed you that would apply to any other stock or any other index, in my opinion. And now we move on to stocks. So I covered this briefly at the tail end of the yesterday's video. I'm going to speak mostly long-term here. Right now, we've got this euphoric mania in the market that the Fed has pivoted, and the market is pricing in either a soft or no landing with, I always joke around, say 110%, like without a doubt, the market is pricing in, the market's priced for perfection. In other words, God forbid, God save this market if all of a sudden, in 2024, the economic indicators start rolling over hard and showing that we're heading into a hard landing, a solid recession. That would be, you would see such a rapid shift in sentiment. Earnings would be adjusted downward so fast. and there's so much hot air. Again, I say that only because it's such a one-sided, looking at market action. Everything else I showed you recently, and you can do this yourself. Go pull. I did this just yesterday. Pull the 30-year mortgage rate. Heck, I can do it for you. It took me a second. Just Google search it. This is Fred. This is the Federal Reserve, St. Louis. And you have here, this is the historical rate. This is when rates peak. This is the very much plays in my analysis. We were in a inflationary rising rate environment. We've been in the longest and strongest period of falling rates, which was the nobody. I don't think if anybody were to try to even make an argument that had nothing to do with the super secular bull market that we've seen. They just really, sorry guys, it's not even debatable. We all know, anybody that's studied the financial markets or economics knows that falling rates is beneficial for the stock market, rising rates is not. And you can say what you want about where we're going. Well, the market certainly has its strong opinions recently that the war on inflation is over, but this was a secular trend, and a trend's been broken by every metric, including higher highs and higher lows. Where that's over, and we've embarked, I believe, on a multi-year, even multi-decade era of rates that will be rising. I feel strong on that. Again, from the technicals and from fundamentals. Right or wrong, time will tell. But okay, let's not get too far away from that. Let me just zoom in here and show you again, which is why I'm talking with such, I'm not trying to be dramatic about the potential for pretty much a crash next year if things don't go the way the market is pricing in, only because everybody's on that side of the trade, at least the way the market's behaving. You may not think that. Some people out there are doubting, but it doesn't matter. The price action, the money flowing into, especially these big things. And what I want to show you here, and I've talked about this recently, I'm just going to show you again. This is the 30-year mortgage rate. This is straight from the, you can get these charts anywhere. All we've done right now is pulled back to where we were back here. That's when the market bottomed. The S&P 500, the NASDAQ 100 was at the lows back at the last fall in 2022, October 2022. So all this has done is taken us back there, yet the NASDAQ 100 is now at new multi-year highs versus where it was back then. And so this is where rates have done. So this has just been basically a little abatement in yields. Yes, it looks like to me a lot more. I do think rates are going to continue to fall. But what this is also showing us is, and I talked about this, mortgage rates haven't fallen as much as the 10 and 30-year bond because credit conditions have tightened. And this is very restrictive for growth. And even if we come down here, we're still at very, very high relative rates to anywhere we've been in recent history. And so I just wanted to kind of point that out because, again, the market is 110% pricing this in. And if that happens, guess what? We could have a good 2024 year. We could have a great 2024 year. But God help us if it doesn't. If we get another up in rates, because everybody's on one side of the trade right now and everybody's singing the song, buy bonds, buy bonds, buy bonds, and that doesn't happen. Okay, so keep an eye on things like this. Keep an eye on the mortgage rate. Keep an eye on credit spreads, corporate bonds, treasury bonds. Right now, the market's been dismissive of it. I've talked about the recent disconnect where there's been some days that yields have spiked back up and the stock market continued to rally because, again, it's almost moved on. That's almost old news now. It's everybody, or again, the vast consensus is we have nothing to worry. Rate hikes are over, and in fact, we have rate hike cuts coming. I'm not going to do it here because I've already gone off topic a little too much covering this one, but I did show you recently, and if you didn't see it, pull it yourself. Look at Google search Fed funds historical rate, get a long-term chart. And make sure you find one of the sites that do this, that show you the shaded area of recessions. I've showed you this and go back as long as you want for decades. In every single instance, the recession came after the Fed hike. We're not on that chart. I don't have time to pull it now. I want to move on with the semis, but rates go up in a hiking cycle. They plateau out for a while, just like they have now. Then the recession comes. And so I have very, very little doubt that the lag effect is real and will happen and will kick in. And in fact, you know what? I'm going to show you one more thing, and then maybe I'll just truncate this video at some point and pick it up with part two. Or this is something I wanted to share this morning. I saw a pretty good move down in the futures, and what I noticed is we had today on the economic calendar. This isn't a huge one, but it is something that worth noting. This is the Empire State Manufacturing Survey, and what that is, it's a New York State. It talks, how the business conditions are in the state of New York, and it was released and tells, this is the latest week right here. This is the General Business Condition Index, and New York clearly in a recession by this metric. That was the last official recession. I know there's other folks out there that I respect that are saying right now the U.S. is in a recession. And I've done this long enough. And you, again, this is another not subjective observation for me. It is fact. All recessions are always declared in hindsight after the fact. A ton of revisions come from the BLS. GDP is revised downward in hindsight. And by the time that you hear about it on CNBC or Bloomberg or the NBC Nightly News that we're in a recession, the stock market at that point is already down, usually 30-40%, and the recession is 6 months in, and so you can see here, based on general business conditions, and good. This is from the New York Fed site directly, newyorkfed.org. You can go there and you can look at these charts, and you can see again, it's just a slower roll. That was COVID and the last recession. You can go back as long as you want. These are all flashing recession. So I thought that was interesting. Again, it's only one state out of the 50 in the union. So, but it's worth noting. Okay, now back to the good stuff. This is I had all the divergent highs here going back as far as I can on SOXX. That's the iShares PhilX SOX Semiconductor Index Fund. It's an ETF that tracks that semiconductor index. I'll go over the other two if time permitting. XSD and SMH are your other two big semiconductor ETFs, just run by different companies. You have a different basket and with different weightings of various semis. But I'm going to measure this. Here's how you do it on TC2000. You click, make sure you snap to the top of that candle, and then snap to the bottom of the one. That's 68%. So I say now, and again, I work in probabilities and statistics and odds and all that good stuff, and what I'm doing here, and you make your own decision and decide on your own positioning. I'm just showing you every divergent high that sector or this sector ETF has put in on this all-important weekly chart. Again, big picture stuff. These are trends that last months to years, and as you can see, I've highlighted them all. That was the last real bear market, October of 07 to March of 09, or actually it was in the tech and semis. It was November of 08 when the NASDAQ 100 and most tech stocks and sectors and the big fangs bottomed. Everything else was March of 09. And okay, 28. Did I do that right? Hold on. No, that's not right. Of course not. 68%. I just checked it. Okay, there it is. 68% divergent high, bear market. Next divergent high, these are all bull market corrections. 29%, 28%, 27%. I have a notification DH2. Randy. Pardon me, my little smart device is giving me a notification on the side here. You probably caught that. Okay, 27, 20, 39, 42. And I told you yesterday, I think this plays out like this. So this to me has one of the biggest profit potentials as a flexible trader willing to go long or short. I think we'll work our way down, and this is how I think something along these lines, how it's going to play out over the next 1 to 2 years, ultimately work our way down here, meaning in 2024, 2025. And keep in mind, stocks tend to fall a lot faster than they rise. You can see down here that only took about what is that, about a year or so. That was 6 weeks when COVID hit, and so you can measure that out. Just know that in a bear market, even in a correction, it is very common, more than usual, to see months or years of gains wiped out in just a matter of weeks or months on the downside. All right, so that's it. And we have the previous high there. We have potential for a big double top. Yeah, if we break out, it's going to be new highs. But you've heard me say this many, many times over the years. And if you're new to the site, I'll say it for that sake. Divergent highs that occur with negative divergence and overbought conditions, right there, have a much, much higher rate of failure, a very high rate of failure in my opinion. So this trend's going, they're buying the market right now. There's a FOMO trade going on like I haven't seen in quite some time. Everything's getting frothy, and there's my targets. There's where I think things are going. And just down to the trend line here is trying to not move all my markers. You know, depending if and when we hit it, that's probably 40. That is a 40% drop. So we're looking at about 35 down to this support level there, about 385. You know, here's the first level right there is 441. That's 25% drop. Just trying to gauge this for you. And that's it. So, you know, we're in 2024. Semis do this and walk our way up here, and then these indicators start moving up, taking out. Well, you know, it's going to be a good year for the semis in 2024. However, what it's going to do, unless we go way, 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 way up, it's just going to extend some even bigger divergences that have been building since that point in time. So effectively, I need to put this up now. I was showing you we have this divergence more recently that's been building, but we also have, now that we have a roughly equal high, maybe even a marginal new high against lower highs in the indicators. That's big divergence, guys. And that's telling me, you know, I have a high degree of confidence that target's going to be hit. And if you're new to the science, hogwash, well, this is what I'm calling these guys down from here. When I get to the individual semis, you're going to see how so many of those hit my targets. And I can guarantee you, when I did that video back in the, you know, at the end of the year, December 2022 last year, or 2021, before the bear market started, and I was calling for these big drops, very few, if any, probably took the trades, and most just said, oh, that's ridiculous. You know, you're not going to see NVIDIA drop, you know, 70, 80%. Are you kidding? And, you know, it did. So let's get to those now. Before I get to all the other, I told you I'd look at the others as XSD. So remember, each of these semiconductor ETFs have a different basket. They have a lot of overlap, a lot of the same companies, a lot of overlap there, but different weightings. And then some have different semis than others. So it's not the complete same sector. Some have more holdings than others. This one is yet to make a new high. This is XSD. And this trend line here, just so you know, looks like a magnet to me. These trend lines, bull market trend lines, they get what I call visited every now and then. The longer you go, every now and then, the higher you get, the more painful that reversion to the mean to come back in for the trend line is. And you're going to get it, and you check the trend line, then you go, you have another bull run, you get too far ahead. Divergences tell you when that's coming. You get the divergence. Divergent high. These are all divergent highs right here. Divergent high, all these corrections. You can see them. Got really far away from it here, and we haven't visited that trend line in a long time. Now, so this is my bullish outlook for the semis right here. I'm talking that 55. Let's see, to get to that trend line sometime next year, it's going to be at least, or roughly, let's say right here. Let's say it happens soon. Happens 5 months from now, we hit that trend line, and that's a 38% drop in XSD. My most bullish scenario is calling for that 38% drop, which I have a high degree of confidence in. Again, we could go higher, and then it gets higher. We could even put some divergence in here, but we'll visit that trend line. We'll just fall from higher levels. But that would be my most bullish expectation, right? This, in all trends, don't last forever. This is a very, very long in the tooth bull market that started back in late 2008 for the semis. And I know very, very few out there. Even, listen to see some YouTube channels or people come on TV and some folks bearish calling for like me, adamant we're going to see a recession in 2024 and maybe it already started. But very few see how just far this market can drop. So what I'm getting at here is, yeah, I fully expect if and when we get there to bounce. And I will most likely, again, if other things confirm, the broad markets, the QQQ, the other semis, the charts of the big semis themselves, I will, like I did before, cover shorts and go long for a bounce there. But however, my more bearish scenario says these secular bull market trend lines break. And then there's just a lot more downside to come. But again, getting ahead of myself, I'll tell you at the time, if and when we get there. If it's 2024 or 2025, or for some reason sometime after that we next fall to this trend line, I will most certainly give you my thoughts if and when we get there. SMH is the other one. And that one has just, again, beautiful, super well-defined uptrend lines. This is your primary trend line right there. That is from where we're at now. We do have a divergent high there as well. Again, depending on if and when we hit it. That means, do we reverse from right here? Do we go another 10, 15, 20% higher? But if we fell from the current levels and we got there in about 5 months, again, that's where I'm dragging it, that would be about a 44% drop. And again, that's a magnet. That trend line has not been visited since back here. We've had it's been quite a while. Oh, COVID was the last time we checked it. I'm talking the primary. I have a secondary minor trend line that comes in a little bit under it right there. And again, looking at this chart, I know there's some out there saying, Randy, yeah, but you're crazy, the CHIP Acts and all that. No, you know what? Who knows? We have an election year coming up. Maybe that gets some of those things get unraveled. Maybe they're fully priced in. I don't know. I've heard some people that know the industry a lot better than me saying we're going to have tons of big, semiconductor plants sitting idle in the next couple of years in the U.S. with nobody in there. This money to build them, and then boom, collapse in the demand for chips. Or who knows? I don't know what'll happen. That's not my thing. I do like fundamentals. I have a background in fundamental analysis, but this tells me I'm looking at the most bearish setup since, well, not since COVID, since this drop right here, which again we called it down with near impunity here. Now I'm going to get into the individual names. Let me go to SOXX so it'll load that watch list. And I'm sticking with this weekly time frame for now. This is NVIDIA. This is the last divergent high. These were the targets I laid out literally before anybody knew there was a bear market coming or that we're in one. You can see created that back on updated. No, wait a minute. I hit the wrong level there. Yeah, there it is. Created 9/30, September 30, 2021. That one as well. September 30th, 2021. We hit that to the button. I did give you at the time, I believe, the 2 additional targets. These may have been added later. Let me see. No, September 30th and February 3rd. That one I added later on. But so what happened? We hit T1, we bounced. We hit T2 almost to the button right there. And at the time we had, there was divergence. There were reasons to go long on the daily chart right here. When T2 was hit right there, big positive divergence you can see, and the stock bounced, as it often does. The bounce has been very impressive, no doubt. It's taken us to new highs, but all that's done is put in a new divergent high. This one has plenty of room if it wants to. You can look at the indicator, severely lagging. If it wants to go up for a few more months, rally into January, February, maybe first quarter next year, easily see that. This one, all I can tell you, and as I told you before, I've been harping on this chart for months since back here. I said unless these purple lines go, this is one of the Mag 7 right here, NVIDIA, one of the largest companies in the world now. And I said until these are my lower purple lines, this uptrend line and this one right here, with a secondary purple, very important support level right there, which we hit to the button when all the other fangs or Mag 7 were hitting my other purple lines. So This one basically bounced off support. So what I've been saying for months hasn't changed. We had negative divergence then. We put in a marginal new and still divergent high. The divergence just got a little bigger, and we're still above support. You've got the 200-day moving averages. This, to me, is what I would refer to as massive support. It is massive price support. It's the bottom of this trading range right here, very well-defined sideways trading range. It's the key 200-day moving averages. It's the top of this massive gap right there. And it's my lights out moment for the semiconductors in NVIDIA. Whether it comes in the next couple months or whether it comes sometime later in 2024, I have a high degree of confidence it's coming. So much I mentioned recently, I'm long since kind of just got away from ever doing any kind of options trading. It's just I like shares. I like trading futures and individual shares. I always say this, and you've heard me say it before. You know, I learned this long, expensive way years ago. Thing about options, and there are paired trades that are more conservative, but if you're just buying puts and calls, it's hard enough to get the call right on where a stock is going. You know, it's hard enough, in other words, to say when NVIDIA is here and everybody loves it, that it's going to drop 69% and then bounce. That's, sometimes I get it right like this, sometimes I don't. But it's a whole nother degree of difficulty to call when it's going to get there. And that's why I keep trying to give you these projections of when I think they're going to get down there. Because we could have done this and then finally got there. And if I had a bunch of options that expired around this time, guess what? I would have been right on where the stock was going, but I would have lost money, or at least, you know, not fully capitalized on it. So that's what I was talking about. You have to get the timing right. Because as those options start to approach maturity, you get that massive decay going. The volatility premium, depending on where you're at, the time premium, everything's just melting off like a hot knife through butter. But in this case, like I said, I have confidence that we're going to get to those targets. And I also, as I've been showing you now for months, I have the levels in which my confidence will go up a lot higher. And that's why I do these videos. That's why they're long-winded. But it's not just NVIDIA. NVIDIA is the king of the sector. It is the 800-pound gorilla. It's the old Intel or the old Texas Instruments, those former leaders. This is the one right now, the lead sled dog that the rest of the sector will most likely follow. And, just like Apple, Microsoft, and Tesla, the old Mag 7, until you take out the generals, the market, this bull parade's going to march on. Take out the generals, the rest of the market will fall. Same thing with the semis. So that's why I'm going through these in order of market cap as I'm going through the list of these components. Now, I'm not going to go through them all. The request was to go through some of the individual components. Oh, well, be honest with you. There's only, in stocks, there's only, my watch list shows me, or what is that, 30, hold on one sec. You probably can't see in the video. Move down here. There's the watch list. 28. There's only 28 components there in SOXX. So it's not too much, but we don't need to go through them all because like everything, just like the stock market, those that are at the top, NVIDIA is a $1.2 trillion company, market cap wise. The next largest here, Taiwan Semi, is only 526. You get down to the bottom, SMTC, and it's only, but it's still 1.3 billion. So it's, near about almost a tenth of the market cap of NVIDIA. It's not going to move the needle. And here's a great example. I wasn't going to go over them all. There's one that looks actually a lot better than the rest. Look at that big positive divergence. Now, fortunately, it's already moved off, 75% off that divergent low, but that's weekly. And just like you had, you can see it there, negative divergence at the highs, right? Right there, lows, positive divergence at that low right there, a little divergent low. So you get the drift. But let me go back to the next one. Taiwan Semi, beautiful uptrend line. Right here comes off the, again, the '08 lows. That was my current final target. That's what I stated at, covered this in multiple videos. First gave you that target back in February 3rd of 2022. That target, and I listed it being and told you I was covering, going long. That was my current final target. So I had revised that or listed it as, it remained my final target. Current final target T2 hit. And we bounced. So it's time to cover that short, go long. Why? It was great support, number one, big reaction high there, and more importantly, that uptrend line. So, and we bounced. Now, we've come full circle. Since that final target was hit last year, the stock has rallied 85% right off that level and hit S1R1. What does that mean? S1 means first support, R1 means first resistance. That's because support, once broken, becomes resistance. So here I had it as support. It was also a level, I believe, given you at the time, if you weren't already short, if you didn't take any of the early sell signals, this was the most powerful sell signal on the weekly. This is what I've been talking about a lot lately, these areas of consolidation, these sideways ranges, especially with negative divergence. They are indications of a major top. And so far, that was the top. Despite this 85% rally, we're well off those highs right there in Taiwan Semi. And you can see S1, which was support, gave us that sell signal. If you zoom in nice and tight, what happened? It was textbook technical analysis. We broke down, then we back tested a couple weeks, failed because its support has now become resistance. And then you got that, hit support, rallied up, hit it, boom, rejected. Hit it, boom, rejected. And we're coming up on it again. All I can tell you, if it breaks out and it's a sustained breakout, anything more than a brief whipsaw or a failed breakout after that, that's bullish. I can't spin that any other way as bullish because it will have broken out of resistance. So if you are a bull in the semis or you're looking to buy Taiwan Semi, from longer term, this weekly chart, all I can tell you, it's not objective to go long here. You're coming up on resistance. It would be more objective to wait for a breakout above that resistance, or a bear could short. You can wait to get a little closer if you want, or you can short here with a stop somewhat above if you want to. If you're playing the long game, if you're swinging down here, minimum target would be the bottom of the trading range, 80-20. Next target would be the trend line. Then I had what targets I gave you before, and I called them potential T3, and that's the next one, and that's still let me just say, if I get a little more confidence, if we start to get some sell signals, I see this trend reverse with some evidence that it's probably over and a new downtrend started, I'll most likely make that an official or not, I'm throwing out the levels. That's where I think it's going to at minimum next year, and that's going to be a drop of, let me go over here so I don't move my trend lines. That's going to be a drop of 56%. And of course, you have the trend line, but we just checked that trend line. And again, no trends last forever. So I am expecting a lot of these long-term secular trend lines in the semis to break. And that would take us down there. And that's actually, I'll give it to you now. All right, so potential T4, kind of, again, potential when I can make a stronger case. Right now there's certainly a bullish trend going on, so I can't make a super strong case. I really don't have sell signals. All I have on the semis is coming up to resistance, but that would be a pretty big drop there. Okay, I won't go through them all, a few more, and we'll wrap this video up. Broadcom, another one. Look at this. I mean, birds of a feather, guys. That's why these charts look similar. That's your bull market uptrend line, Broadcom. Lots of nice reactions. Last time we checked it was back when COVID hit. And this thing is long overdue. And typically the bigger you get away from those trend lines, the more painful the mean reversion to the longs and the more profitable to those that are flexible and are willing to short. It's one thing to just say, we haven't hit that trend line in a while, so we're due. It's kind of like a batter in baseball. He may have struck out the last 4 times at bat. It doesn't change the odds that he's going to get a hit. It's just like flipping a coin. You can flip a penny a dozen times and land on heads, and you might think, absolutely, the odds for tails is higher. No, it's always 50-50 every time you flip that coin. So what I'm trying to get at here, I could randomly say, it's been a long time, so we're going to hit it. No, what makes me think we're going to visit that trend line soon is this. We have a divergent high, very steep divergence on Broadcom. This one's been ripping lately, and there's your trend line. So you can either wait to see, you'd probably have to zoom down, and this video would go for 2 hours if I went to all the time frames daily and 60-minute charts, but you'd want to zoom down and might get a earlier sell signal on the shorter term charts that I just mentioned. And it could come in the form of trendline breaks, support breaks, bearish. Probably look for bearish candlestick reversal, and also other sell signals in the indexes, particularly the tech heavy Nasdaq and some other semis. Then that would tell you, because Broadcom, again, you guys, this isn't rocket science. When you go back and overlay all these charts, they pretty much overlap each other. These big corrections and bear trends, they're all the semis, like I said earlier, birds of a feather flock together in this one sector. They all tend to ebb and flow together. There are some exceptions. I pointed out, one that had a more constructive chart recently happened to be down at the bottom of the barrel, that SMTC. And it looks a lot different. But for the most part, you see NVIDIA in Taiwan Semi. They're all in those uptrends since late '08, early '09. Broadcom. Next one up, ASML. Here's your uptrend line. Actually, that should be extended. Does it go back here? Almost. I'm just going to leave it the way I had it. This one's been around for a while, 2002. But there's your primary uptrend line. And again, the common theme here is they're just clean. These are, I don't have to force them. You've heard me talk when people ask my opinion on a chart or I'm analyzing something. And I'll tell you, here's a trend line I have, but I'm not so crazy about it because it feels a little forced, and it may come into play. That's why I'll mention it. But in these are very well defined, very important secular bull market trend lines with a lot of distinct reactions, no violations. That makes them very good, significant trend lines, in my opinion. I didn't measure them all, but you can see all the divergent highs. They were all, each and every one on this weekly time frame, followed by a correction. I started measuring them here back in 2020, 41% drop. This one here, again, I laid out this target February 3rd. That was right of 2022. So we were up in here. The bear market already rolled over. This one would have been covered in the same kind of video I'm doing now. Back then, I would have talked about this trendline break and back test. And so that one fell. Oh, and I had looks like I created that one. Yeah, also on February 3rd, back here. And this is why I gave you two targets on this one, two and only two. We hit that second one to the button. So you can see now, guys, this isn't mere coincidence. This is too random to be calling these things from here to the button, hitting those final targets and seeing that bounce. And it's the same analysis I'm applying now. And given this uptrend recently has been strong, but really no stronger than any of these others, especially leading up into the highs. And that's the thing about the market or a stock or a trend. Everybody's bullish. You get that FOMO, the fear of missing out. And usually when things start to go near vertical or near parabolic, that's usually when the big corrections come. And they come pretty hard and fast. All I can tell you with certainty is that we have another divergent high. Let me just borrow this one, duplicate that, DH. We had a divergent high right there. If this one wants to continue to run up a little more, let's look real close. I'm going to put the line right there. That would be an equal high if I make that line horizontal. But then if I take these divergence lines, they come out. And so any equal or marginal new high anytime soon will still be a divergent high. And so I'll just take this, move it there, just like in football. You get the first down, they pick up the chains, move you forward, you have another 10 yards to the new first down. And then at some point, I keep doing this, and we keep doing this, and then these go up, and guess what? That gets deleted, or at least I'll make a little note. I'll put an X through it, say it didn't pan out. All right, so that's that. That's where we're at. Near term, again, you'd have to zero down to the daily or 60-minute charts. Look for a sell signal. There's no sell signals right now in that one. AMD, some of these charts you can see here. I haven't updated these in a while, but there it is. We just made a marginal new a high right over a resistance level I had around 132. All I do is put the divergence there. And all I can do is extend it over from here as well. So this is really, no, take that back. For that line I just did, we'd have to connect, we'd have to have an equal or higher high here. I'll leave that there. Sometimes I'll just color it up a little different. So, and look, I may be talking about that in second or third quarter of this year if we do that. And you're going to say, well, Randy, you were talking about these divergences back then last year and they didn't play out. Again, divergences are not a sell signal. They're an indication that momentum is waning and that an impending trend change is likely, but not guaranteed. So I'm going to take that off. Well, you know what? I'll put that back. I'll just make it that yellow color just to kind of remind me that, you know, if these guys power into 2024, then the top isn't coming as soon as I thought, but still indicated that it's likely coming. But what I can tell you is that divergence it's really what I call potential, because you have the PPO, in my opinion, in my book, it needs to curl back down. You need to get a bearish crossover like that puts in a lower high, because this is a momentum indicator. And if it can, right now that momentum is pointing up. So we need to see a reversal here before we take out that previous high. But it's what I call potential divergence, and it is. So I'm going to just mark it as a divergent high. Intel. This one's interesting. Okay, this is a great example of what I kept, on SMTC, I showed you one that stood out from the rest. It was at multi-year lows instead of multi-year highs, like a lot of semis right now, or near multi-year highs. This one was also my favorite when I was, still shorting or bearish the market, or this is when the market was bottoming, but we traded this. I pointed this out as my favorite, the most bullish looking of all the semis. The rest had different looking charts. This guy had already peaked. Intel used to be the big dog in the sector, had already peaked and had its own unique problems. They were behind the curve, no AI stuff for them. AMD was eating their lunch on chips. And so it was constructive. We had a big positive divergent low, and it's rallied. However, I'm looking at this. I put this one out as a short recently, and I can tell you this right now. Let me just give you my thoughts. I think it's still going to play out, but I would definitely not short it right now, because we've now broken out. Today's Friday, so this weekly candle is probably going to print a close above that level. I suspect it'll be a whipsaw. This stock is very oversold. It is in a bear market by just about all metrics. It's way, way off its highs. And you can see in a bear market, even in a bull market, but especially in a bear market, oversold is usually a one and done, pretty fleeting thing. And we are oversold on the RSI. Last time we were oversold right there at the end of the bull run, and you can see that happened. Time before that, we were right here, and then that happened. I think you can see what that is when I refer to that, and just see what happened to price. Oversold, 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 oversold now. And this was a bull market, and there's a great example of what I talk about, how oversold tends to become more overbought, guys. I'm saying it backwards. Overbought. Tends to become more overbought and or stay overbought for an extended period of time, but it ultimately set in right there. And again, it's just an indication. You really, you don't want to be, you either want to be looking to close out your longs, again, aligning with other technicals, or looking to short when you have overbought readings. You don't want to be adding or buying a stock. So that's why I put a very high degree of confidence this breakout's going to fail. But again, the way I would look at this is you don't short on a breakout above resistance. If anything, you buy it, and if that's your thing, if you think it's going to stick, and you put a stop below in case the breakout fails. But if you're looking to short it now you want to see the breakout fail. But like I said, most likely it will, for the reasons I just showed you there. All right, I don't know how many more to cover. I'm just going to rifle through the charts faster and show you. This one looked really nice here. Again, positive divergence. Looks simple stuff, right? Divergent high, correction. Divergent low, rally. Right at resistance right now. If it's a bear market, that's probably all we're going to get out of that divergence, and we're going to head down here. That's my next target. Let me just do this. T1, I'll just put today's date. 12/15/23. It reminds me I added that wasn't from before because I didn't have any targets here on this one. These levels would have been covered in the videos, but I would put a high degree of confidence this one's going down there. You're at resistance now. You can take a shot here. Again, it's a highly, highly aggressive counter trend trade because there's a strong bid right now in the semis with no signs of a reversal. But, it's at resistance, and this is trading 101. You either short a breakdown of support, or you short a rally into resistance, especially an overbought rally. Last time we were overbought there, and then there. You got that. And so T1 would be, and as far as stops go, especially if you're going to step in now, if anything, what I'd recommend, just like the indexes have done, partial positions. It's not an all-in moment in the short side right now in the market. If anything, there's buy signals and a strong trend. But I like to scale in. So you take a shot here, for example. I'm not giving any specific investment advice. You take a starter position. What does that mean? 1/4, 1/3, no more than a half here at 143.20 resistance, or 143. I'm measuring it. The drop I'm looking for is a drop of 34%.